Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson. Current versus long-term assets and liabilities. One of the most important aspects of accounting is to classify assets and liabilities into current and long-term categories. This helps to measure the liquidity and solvency of a business, as well as to compare its performance with other businesses in the same industry. Current assets are those that can be converted into cash or used up within 1 year or less. Examples of current assets are cash, accounts receivable, inventory, prepaid expenses, and short-term investments. Current assets are essential for meeting the day-to-day operational needs of a business, such as paying salaries, suppliers, taxes, and interest. Long-term assets are those that have a useful life of more than 1 year and are not intended for sale in the normal course of business. Examples of long-term assets are property, plant and equipment, intangible assets, goodwill, and long-term investments. Long-term assets are important for generating income and creating competitive advantage for a business over time. Current liabilities are those that must be paid or settled within 1 year or less. Examples of current liabilities are accounts payable, accrued expenses, short-term loans, taxes payable, and current portion of long-term debt. Current liabilities represent the obligations that a business has to fulfill in the short term using its current assets or generating new current liabilities. Long-term liabilities are those that have a maturity date of more than 1 year and are not due within the current year. Examples of long-term liabilities are long-term loans, bonds payable, deferred taxes, and pension obligations. Long-term liabilities represent the sources of financing that a business has obtained for its long-term assets and growth plans. The difference between current and long-term assets and liabilities is crucial for analyzing the financial position and health of a business. By comparing the current assets and current liabilities, we can calculate the current ratio, which indicates the ability of a business to pay its short-term debts with its short-term resources. A higher current ratio means a higher liquidity and lower risk of insolvency. By comparing the long-term assets and long-term liabilities, we can calculate the debt-to-equity ratio, which indicates the degree of leverage that a business has used to finance its operations. A higher debt-to-equity ratio means a higher reliance on debt and higher interest expense, but also a higher potential return on equity. By understanding the nature and implications of current and long-term assets and liabilities, we can make better decisions regarding the management and investment of a business.